Good afternoon, everyone. Welcome to Link's analyst briefing for the year 2020-21, which we are hosting today via webcast in consideration of current public health and social distancing measures. Today, we are pleased to have with us our CEO, Mr. George Hong Choi, CFO, Mr. Kok Siong Ng, and CSO, Mr. Eric Yao. During the course of the webcast, you may submit your questions through the webcast portal, and they will be conveyed to our management during the Q&A session. Thank you, management, for the presentation. There are quite some questions coming from our analysts. The first question is actually on Hong Kong retail. So regarding Hong Kong retail, you have said that you hadn't seen positive reversion in Q4. So which segments are actually driving this positive reversion? And do you see that Hong Kong retail has already, bottomed in the worst scenario, and have you been seeing recovery?
Yeah. Okay. We have been seeing more encouraging leasing results, not just from a recovery of the reversion, but also in terms of difficulty in lease negotiations. We saw tenants were a lot more hesitant in expansion and a lot more hesitant in opening shops previously. But as the COVID situation in Hong Kong improves, as mentioned, we have seen over 400 new leases being signed over the course of the last financial year. And even in the first 2 months of this financial year, we have seen quite a number of new leases signed, both in Hong Kong and in China as well. I think the few particular trade categories which were very encouraging are F&B, a lot of the smaller restaurants, and providing niche cuisines. Those have been very active in opening shops in Link. In addition, also we see, of course, the non-discretionary segment in the supermarkets and in food and beverage, food-related shops are also opening quite confidently as well. Another category is health-related, health products, health goods, healthy goods related. Those are also doing quite well and eager to open shops. So it's difficult to say whether it's bottomed out or not. I think it really depends on which segment and which trade mix we're talking about. But I mean, all in all, we do see a remarkable improvement in sentiment in the last couple of months.
Thank you, Eric. Then there's a question, let me combine the question from Cousin of JP Morgan and also Carl from BAMO. They asked about the rental relief or the rental concession. So what's the remaining impact of the rental concession on this year or this period? And do you see the need for incremental relief measures for the coming financial year?
I think we have a sufficient amount already provided to our tenants in Hong Kong. With the situation in Hong Kong stabilizing, I really don't see further rental concession necessary unless we have another wave. And so fingers crossed that we are fine in Hong Kong. In China, it has rebounded very quickly, but I guess you have all read about the situation in Guangzhou. It will have a short period of close down, which will impact on businesses of some of the trade. We are talking to our tenants about how to support them, but I think the amount for that will be quite limited. Accounting-wise, KS?
Accounting-wise, I think specific to the rental concessions only, those, like we said before, will be amortized over the remaining lease. But if you look at the whole pot that we announced of 600, actually a large part of them were in management fee, service fee, car park discount waivers, which have all been accounted for the last financial year. So going forward, nothing material in terms of the amortized effect of the concessions.
Thank you, George and KS. There's a question from Andy of Haitong. and he's asking about the occupancy cost. So now that the occupancy cost is probably at a 5-year high of 14.1%, and combining a few questions again, so do you have any guidance on the coming retail rental reversion for the next year?
I mean, we don't think there is a cap per se on occupancy costs. We've always been saying we think mid-teens would be a comfortable figure for most of the tenants, but of course it will vary trade by trade. Obviously, last year was an extraordinary year, which can't be used as a benchmark. We do hope with the release of lockdown restrictions and easing of social distancing measures, tenants' turnover and revenue will recover better, and so we should see occupancy cost easing to even more comfortable level. Let's put it that way. But we don't think at this point it is too stressful for the average tenant. But when we saw it becoming stressful for particular tenants, that's when we offered the tenant support scheme and the rental concessions and property management fee waivers. So this was dealt with on a case-by-case basis over the last financial year.
I mean, to supplement, we didn't help every tenant. There are some tenants who we believe can take advantage of this opportunity to change, and therefore we have that many new leases and new shops and restaurants opened, and improve the variety that we provide to our shoppers. So we think that the occupancy cost ratio, while it has risen, is temporary once sales pick up.
Thank you. Then there's a question on the balance sheet from Cousin. So his question is about, well, currently the gearing ratio now getting closer to 20. What's the gearing level that the credit rating agencies or the credit ratings may start to be affected? Or what's our comfortable gearing ratio?
Like we have mentioned in the results, I think post-distribution, post-acquisition, it will tip over to 20. What's our comfort level? I think, like always, leverage is about triangulating your maturity, your coverage, and getting the right LTV. Looking at where we are in terms of these three criteria, my sense is mid to high 20s we can stomach. Still very comfortable, nothing to worry the investors or the markets. As far as the credit agencies, I think we don't see a big issue around how much more buffer we have. If you look at the equivalent ratings in the other economies that have been awarded the same, there's actually quite a lot more buffer if you look at where US or even Europe or Singapore. So I think we have been pretty stringent on ourselves with the agencies on what A in S&P should look like. So I think over time, we hope that we can then align internationally on how the ratings look like. But on a practical basis, I said up to 25-30%, I don't think it's an issue, so long as we have the opportunity to push things out, manage the liquidity and the coverage. So rest assured, this is not something that is something that we worry about as of this stage.
Okay, thank you, KS. One more question on capital management from Philip of BOCOM. Will you set a buyback budget for the next year, or do you have any numbers in mind for the buyback?
We have no numbers in mind simply because there's a lot of capacity on balance sheet in order to reflect the right value of what our unit price should be. And that means the second question is what is the right value? Is that if there's a event where market, if you ask me, short us unnecessarily or long us unnecessarily and cause disruption to a price that does not reflect the value, then we have a responsibility to go back in to protect the unit price for the sake of the market, for the sake of the unit holders. So we have an agreement with the board that we would do that if that comes.
Thank you. Then the next question is on disposal. So there is a question coming from Javon of JP Morgan. Do you see reviving investment sentiment for disposals? So do you, while we say that we don't have an immediate plan, so, but what about any plan in the further down the road?
Our investments are on general long term, so we don't have any particular plan for disposal per se, but we do review our assets on a regular basis. Our team of asset managers do review whether they believe that in the long term these are assets that we should hold or not. Those reviews are done on a regular basis. So in terms of a particular plan, we don't have any for in the near term, but opportunistically we may. So not really answering your questions directly. Having said that, we've seen in markets where we have looked at acquisitions, capital value has gone up. Cap rate has either been stable or have come down. And as the situation in Hong Kong retail stabilizes, we'll expect the same as well. And so there may be interest from potential buyers, but that there is no particular sort of plan right at this stage.
Thank you. Next question is on our latest acquisition on Happy Valley. So what's the plan for this asset? Can you share with us the AEI capex for the asset enhancement, please? That's from Mark from UBS.
Yeah. I guess Happy Valley in Tianhe, Guangzhou is a great asset in terms of short-term and medium-longer-term growth because as we announced, the current occupancy is only 70.3%. And not just that, a lot of the leases will be expiring in the next 1 or 2 years. So in the next 1 or 2 years from the current lease expiry, we expect the management team can deliver a good set of growth from just bringing the rents to market level and also enhancing the tenant mix. In the medium to longer term horizon, because of the vacancy, which was a result of the departure of the department store in the asset, we haven't taken over the asset yet. We should be completing the transaction and taking over the asset in a few weeks' time. And once that's done, as with all other asset enhancements, takes planning and get the approval and procure the contractors and so on and so forth. So that would take a matter of months or at least a year before any construction takes place. And with construction periods, so on and so forth, it would be really a 2 to 3 year or even 2 to 3 year term horizon before the asset enhancement will be done and the growth from the enhancement be reflected. So what I'm trying to say is, in short, from near term to mid term, we do expect that the Happy Valley Shopping Center to offer Link a decent growth trajectory. But in terms of the capex amount, not having done the full-scale asset enhancement analysis yet, it's difficult to pinpoint a particular figure. But we rest assured, once that figure is out and agreed, we will be transparent to the market and announce it.
For those who haven't visited the property, it's sort of an L shape. The department store is at one side, which is now vacant. The other part also have some vacancy. So the near term, which Eric described, will be filling in the vacancy in that shopping mall proper. And then the department store portion, we are going to relay out that into shopping center-like layout. And that will be done, as mentioned, a year or two later. So you wouldn't see occupancy go into the 90s very quickly. If we show you the percentage occupancy of the two different parts, one will be 0 for a while, the other part will be getting towards high 90s as we normally do after acquisitions, and with these expiry coming, hopefully extending them to and replacing them with good tenants. So it is a two-step process. It therefore provides us a two-step growth through this property.
Thank you. Then suddenly there are a few questions on the acquisition strategy coming in from Praveen of Morgan Stanley, from Ken Yeung of Citi, and also Will from CIMB. So I'll be combining a few together. So in terms of acquisitions, do you see, or where do you see opportunities in the near term? And if you need to compare between the opportunity in China and overseas, where do you think is a better use of cash for between these two markets? And so maybe I'll stop here first and then ask the rest later.
I think we are after we've been telling people we are looking at all these markets. The good thing is that whether it is the banks or real estate agents have been showing us all the different opportunities. So I think that first step is very important, is that we are in the deal flow, we are looking at different opportunities. But to get us to have these assets pass our underwriting standard, it has been probably more challenging. We do look at a lot of opportunity before we actually find one that we then sign up to. And so I don't see that we will lower that underwriting standard at all. In the meantime, we have seen a lot of money flowing into commercial real estate. Cap rate to some extent have been slightly compressed. In markets like Australia and in London, property price in fact have gone up. So we are not chasing them. We're looking for the right asset to acquire. When we compare assets across different geographies, we look at which one will provide us the best return. We look at each one on a case-by-case basis, but also on a relative basis, which one provides us the better return, and we choose those. So you know, we have said that many times, that we don't have a particular target for each location, and therefore allow us to really compare across geography. Obviously, each have different risks, you know, foreign exchange, legal, leasing risks, etc. But all in all, so far, it allows us to find the best asset to invest in.
Okay, thank you. The follow-up questions is about asset class. So so we see that your target or the guidance on office, it's about 20% or less than 20% of the portfolio. And while there is the work from home impact from COVID, then do you still see good opportunity in the office sector? But looking into your portfolio, there seems to be more opportunities in office comparing to retail. Is that a good conclusion?
We have done a few. I think we need to split this into several parts. So let me firstly address working from home. Working from home, I think it's, depending on who you listen to, it's largely a temporary phenomena. We believe that people will go back to the office. But what is permanent is that the work from home situation and also COVID have been a wake-up call for some employer where they have squeezed too many people into the office. It's poorly designed internally. Wellness was not a concern, etc. And those can no longer last. So what it actually means is that once employers start to think about how to improve the working environment for their staff, there is actually a demand for good space. So what we've been looking at are premium grade A offices with good design that will last in the long term. It will allow us to look at opportunities that are, you know, green buildings with WELL certificates and things like that. So those will continue to be in demand. Secondary offices, I think, may be a little bit more challenging if we can't be converted. So that deals with hopefully your first part of your question. Then when we look at opportunity, Last year, yes, we did buy 2 office buildings, and then subsequently, more recently, shopping centers. But the 2 offices provide some unique features, as we mentioned earlier. Long WALE, very good tenants, very few tenants in each one of them, so there's not as much management of tenant relationship, etc. We managed to find good local partners to help us to manage it on a day-to-day basis as well. So it was an easy plug to a gap that might have been created because of COVID impacting on retail sales in Hong Kong and China, reducing our rental revenue. So these are, in a way, opportunistic, but at the same time, because of the particular nature of those 2 assets, allow us to have growth in there, allow us to have stability, and deliver a result for us this year of a small increase in DPU.
Thank you. Then there comes a question on China retail, or your view on China retail. That's from CLSA Alvin. Can you share with us your view or your outlook on China retail or rental reversion going forward? And also a question from Jeff of DBS, and how likely will Link change the guidance for asset exposure in China?
Yeah, from the evidence that we gather through our presence in Beijing, EC Mall and Roosevelt Plaza, now called Link Zhongguancun, and also in Guangzhou, and also having bought the 50% stake in Qibao Wanke, we obviously have very good exposure and understanding of retail across the 4 first-tier cities. And we are fully convinced that mainland China retail is still very robust. These markets, China in particular, have strong e-commerce, online retailing habit, but that doesn't mean that physical retailing is dead. Physical retailing is surprisingly alive and better than ever. What we have seen so far is that footfall may not have recovered to pre-COVID levels. It's still about 80, some 90% of pre-COVID levels, but certainly people are more purposefully going to our shopping centers and buying, so the sales that we see from our tenants have not suffered. Car park usage is very strong, and so it's evidence that people are driving to the shopping centers. So having sufficient parking spaces in the mall or attached to the mall will be key in order to ensure the performance of the mall going forward. So, I mean, all in all, we have seen very reassuring performance from our China retail. And so we also been seeing in the last couple of months reversion in China also performing quite well still. As you can see, we have been active in acquiring assets in China, doing Shanghai in April, and then recently in Guangzhou just a few weeks ago. So we will continue to look for opportunities, and fingers crossed, hope we will manage to secure some more. And in terms of guidance for the asset allocation, you see that the guidance being repeated in this results. And of course, with more acquisition in China, we are edging closer to that 20% management guidance that we gave. But who knows, we did try to buy and increase our exposure to Hong Kong, which we sadly failed. So it is a fluid scenario, and we will adjust it as and when needed. But so far, the latest guidance is as we disclosed in in our results.
Thank you. Then I guess a very quick follow-up question on China as well from Jianping of Credit Suisse. Will retail be more of your interest comparing to office in mainland China for acquisition? And what's your view on the office leasing in Shanghai?
It depends on which location, but so far we have been more constructive in reaching deals in retail properties. I think the price gap for office a little bit wider. We believe that in certain cities there have been a lot of supply and might have a dampening to rental growth. But then sellers are not necessarily putting the price down, so that it has been a bit more challenging to look for opportunities in office buildings in China. We are continuing to look for those, but I think on balance, the comment's probably correct that we'll probably have likely more retail property being acquired than office. Office rental, we have only two buildings in Shanghai, one of which have one anchor tenant, and that lease have been extended by 10 years. And so that has secured our longer term sort of well for that particular asset. And there is obviously challenge from a lot of supply in Shanghai.
Thank you. Well, in view of time, I'll read out two more questions. And so this question is actually from Matthew of BNI, and he's asking about AEs. So do you see a potential for Hong Kong AE to pick up again substantially over the next 2 or 3 years from the current level?
I think the short answer is that we have finished one, and to a certain extent, some assets have done two, 3 rounds of AE. We are not going to see those big AEIs like before, 400-500 million. We are looking through about 2 dozens of assets that we are potentially going to execute some more AEIs. But those will be in the range of 30-50 million. I think at this stage of the game where the market is recovering, I think we are going to continue to extract our organic portfolio's potential. And to extend the market is ready to lock in step with us, where a new skin, a new layout, with new tenants willing to pay a higher price to give us the kind of ROE we expect, then I think it makes sense to go back to doing a big AE. But as of now, I think in the next 2 years, I think it would be great to just let the market recover to pre-COVID, and let's see where it goes from there.
Yeah, so our focus of asset enhancement will largely be in the assets in China. So currently with Central Walk, and then later on with Happy Valley in Guangzhou.
Thank you. So here comes the last question, which is actually, unfortunately, a very long one, because a few of the analysts are asking very similar things. So for greenfield projects, what has been the learning from the quayside? And so why bid for Caroline Hill Road site? Does it imply that Link would like to increase office exposure in Hong Kong significantly? And so do you have any comments or the views on the, yesterday, the news about the tender results summary was out. So would you give any view or comments on this?
Quayside leasing up has been encouraging. I think as of now, we are over 80% committed, and getting further up with one large tenant being negotiated at the moment. So it has been slightly disrupted with the protests and the pandemic. But it's pretty much on target in terms of the level that we want to achieve. Yield on cost wise is also largely within what we want to achieve in the first lease cycle. For Caroline Hill, it is a special location. It is, as we said, if there are great opportunities in Hong Kong, we will be interested in. We put in the best price that we can offer, but I guess the best price is not enough, so we didn't win, but we were extremely competitive within that range that you might have seen yesterday. And we were keen on the asset. The comparing with the winner, obviously everyone have a slightly different strategy, slightly different return targets, and how we extract value from investment. So I wouldn't comment on the difference, but we put in our best price. We have a plan that we think will be successful in that particular location. But we might use that in some other place, and when we can find another site to use it. But it does underline our confidence in the Hong Kong long term. We believe that the office market will continue to have demand, and we'll look for other opportunity in the future. Thank you.
All right. Thank you, management, for answering all the questions, challenging ones. And, so this concludes our briefing for annual results 2020-2021. If you do have any further questions, please feel free to contact any one of the investor relations team. Thanks for joining us today. And once again, thank you very much for your support all along. Thank you and goodbye.
Thank you, everyone.
Bye.